Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to host the second edition of Macro Investing Masterclass with two distinguished capital markets experts, namely Chris Watling, CEO of Longview Economics, and Edmund Shing, CIO of BNP Paribas Wealth Management. So welcome, gents.
Hello,
Hi
Paul.
there. Good to be with you. Yeah.
Well, there's been a lot happening over the last month since we last spoke, not least yesterday's predicted 25 basis points increase by the Federal Reserve in US interest rates. So maybe we can start there, Chris. Is Jerome Powell now on hold, or is he going to throw the market to bone in terms of reducing interest rates later this year, as the market expects?
Well, let's hope he's on hold because, I mean, he's certainly tightened enough. I mean, it's quite extraordinary. I mean, if he's not on hold, I mean, he's clearly signaled, it's a signal, they're calling it a hawkish pause, which is wonderful how these terms sort of keep coming up. That's a newish one to me. I'm sure we've had it before, though. But it's a hawkish pause. In other words, they're pausing, but they're going to hold rates higher, or they're aiming to hold rates higher, depending on circumstances. But I mean, if you dig into the weeds, I think the Fed's over tightened, and I think the recession is still coming, and I'm sure we're going to get to that. So I would hope it's the last hike, and then we can actually see. And we forget, in the old days, it used to be pretty quick from the last hike to the first cut. You know, it's just rates haven't moved a lot in the last 15 years, but certainly go back into the 90s and 80s. Aggressive hikes were followed by aggressive cuts was pretty much the norm.
And do you reckon that's going to happen then, Chris? Because I mean, the market yesterday, before, I haven't checked it this morning, but was baking in a 75 basis points decrease in interest rates to the end of this year, and then another 50% in the first quarter. So we were going to be down to around 4% by this time in 12 months.
Yeah, that's the norm. It's normally pretty quick. And, you know, if you look at what's going on in money supply, I think we're going to talk about money supply. The money supply is slowing very sharply across the West. It's not just the US, which everyone talks about, but actually in the UK and Europe, money supply is slowing pretty sharply in the last 6 months. So there's a message there. And that contraction in M2 in the US is directly linked to what's happening in the banking system. If you look at M2, not to throw too many numbers out there, but it's about $22 trillion, and $18 trillion of that, or $17 trillion now, is bank deposits. So the two are deeply intertied, what happens in the banking system and what happens with monetary policy. And so, yeah, I think the cuts, you know, that's what the market's looking at. The market's you know, ever since the mid-March bank crisis, the two-year bond yields have changed dramatically in the US, which is really telling you about that interest rate profile. And they've fallen sharply. And that's the interesting thing that's going on. The markets are thinking ahead of the Fed. The Fed normally follows the markets. And I think the markets have got the message pretty clearly, given what's happening to M2 and what's happening in the banking system.
Okay. Now, Edmund, in terms of sort of like the resilience of the stock market, if we are heading into a recession, what's sort of behind that? I mean, I'm still struggling to get my head around of the S&P up nearly 10% in the first 4 months of this year. I know it came down a lot, but what's behind that sort of positivity and resilience within all things stock markets? Well,
I think, Paul, you need to first of all caveat that a little bit, because most of the S&P isn't really up at all. Right, it's a few stocks. Okay. I mean, if you dig down, it's a few big stocks like the Microsofts of this world that have performed. And Meta, for instance, Meta's up over 100% year to date. It's insane, right? So there are a few very big, usually technology stocks that have driven the bulk of the movement in the S&P. Actually, if you look at the equal weighted S&P, just say all 500, give them the same weighting. How's that done? It's not done so well. Actually, it's actually gone nowhere. And that, I think, would be a fairer reflection of the macroeconomic outlook than the stock market there looking ahead saying, you know, interest rates have gone up a lot and we are at a point now we haven't seen in many, many years. This is going to slow economic growth, and that inevitably will have an impact on profit growth. Now, we are already seeing it. Q1 results showed us negative earnings growth on a year-on-year basis in the US. Actually, in Europe, better. Positive, but let's focus on the US, negative. So I think we are still integrating that. But I think there is a sharp dichotomy between these few big stocks, which are very highly rated and which people really are treating, I don't know, some sort of maybe safe haven, and the rest of the market, which is really not doing very well at all. And actually, if you dig down below the S&P 500, mid caps, small caps, and micro caps in the US, as you go down the cap scale, the size of company, the performance gets progressively worse, in fact. So if you do look at microcaps, they look shocking right now. So it depends what you're looking at.
Okay.
It's a good point, actually. I would just add to that. I think that's a really good point Evan makes. If you know, the Russell 2000 relative, the mid caps, the Russell 2000 relative to the S&P 500 big caps is a very good indicator of whether or not you've started a new bull market, in which case the Russell tends to outperform, or whether or not you're actually facing a bit of economic challenges, as Edmund articulates. And the Russell's doing terribly. It's on its lows of the year, pretty much at the moment. Or just think about the oil price. It's off 11% in 3 trading sessions this month. These are classic economic indicators rather than a few stocks in the S&P 500, which are the mega cap techs that give a very different picture. So it's worth bearing that in mind. You know, the headlines say one thing, but the detail says another.
Yeah. So if we are heading into Edmund, if we are heading into a recession and sort of oil is a bit of a bellwether, would you your preference into small and micro caps or mid caps, which have been sold down, or is it into the safe havens if we go into a harder recession? I mean, that's a sort of like there's a huge valuation gap between the two. I mean, I'm with you. It's sort of like 40-50%. It's historical highs. But where would you sort of like position your portfolio?
Well, this is a good question. I think personally speaking, and this is personally, I'm very dynamic. And so I'm seeing a lot of value in these beaten down stocks, particularly in the small cap area. The UK being a classic example of a market that's very unloved, and small caps within them extremely unloved. Look at the AIM index, it's been absolutely horrific, like the Russell 2000 or the US Microcaps. And I'm finding a lot of very interesting value there. But it is true, for that sort of strategy, you have to be extremely dynamic. And you have to be able to absorb volatility, i.e. if things go down 10% in your face, you shouldn't sweat it. Now, if you're the sort of person that can't do that and sleep well at night, then yes, you should definitely be a lot more defensive. The problem is, Paul, that even a lot of the classic defensive stocks, like let's say the food and beverage companies like Unilever and Nestle, have done extremely well because we've had a lot of food inflation, and they've actually been a bit cheeky. And we've seen what we call greed inflation, as in they've not just pushed through input costs that they've suffered, but they've added a bit more on top for the consumers. So actually their profit margins have gone up because they've done that. Now, personally speaking, would I buy the food and beverage companies today? Probably not, because I think they have been a bit too cheeky. And when you look at the market share gains of discount food retailers like Aldi and Lidl across the board in Europe, you know, Germany, UK, France, they're gaining market share everywhere. And that tells you consumers are starting to vote with their feet and maybe are trading down in an effort to limit the hit to their food budgets by perhaps not buying the Nestle, the Unilever products, but buying own brand or more discount range products. So I think that greed inflation is bound to come to an end sooner or later. It's something that central banks, US, UK, and Europe have all highlighted. So they're all aware of it. But I think that will come out of the inflation numbers sooner or later because consumers are not standing for it.
Yeah. Okay. Now, Chris, in terms of sort of the other central banks, I mean, for small caps or micro caps to work, you need to remove the headwind of sort of like, you know, raising interest rates and a higher cost of capital. I mean, it's absolutely impossible to raise any money in small cap land at the moment, for instance, for growth companies. So what's your sort of view in terms of, is Christine Lagarde going to be pushing up interest rates today? And what about Andrew Bailey down at for the Bank of England?
Yeah, I mean, Lagarde, yeah, I mean, I'd be amazed if she didn't push up interest rates. By the time, obviously, this comes out, we'll know. So I think it's highly likely. It's well flagged that they're thinking of raising at this meeting. In fact, they talked about raising at this meeting at the last meeting when they raised 50, if I remember correctly. They mentioned they'd probably raise again this time. So the market's expecting it. The Fed did it, and that gives them a bit of cover as well. I think the more interesting question for the ECB is how much more do they raise and when do they stop raising? Because as we said before, the Fed's finished hiking for now. It's on a hawkish pause, and the inflation in the Europe looks a little bit more sticky, so they may be less inclined to go on that sort of pause path. But I think what will be fascinating is what Christine Lagarde has to say in the press conference after the meeting and after the announcement today. But so I'm not sure we're ready for the pause yet in Europe. They haven't really warmed the markets up. They've still been a sort of somewhat hawkish. They're still worried about high inflation. And as for the Bank of England, well, yeah, I mean, I'd say they're in a similar situation. I think what's fascinating about the UK is, you know, the chat is, our inflation's sticky, and there's certainly a perception that's the case. It's been slower to come down than it has in the States, and it seems like there's a lot more wage inflation, there's a lot more strikes and all that sort of stuff. But actually, if we've had very specific shocks in the UK and in parts of Europe, particularly on the energy side, and if you take the 10 percentage points inflation headline, there's 3 categories that drive most of it, that actually drive 70% of that inflation. And they're basically electricity within housing is number 1, food inflation's the second, and the third is restaurant and hotels, which is primarily about electricity and food prices. So, you know, the electricity market here is very bizarre, as we know, pricing off the marginal price of gas. And that's caused us real sorts of problems with these off-gen price caps. But if you strip all those categories out, actually the inflation pattern here is very similar to the US. So I'm not sure how much more Bailey will need to raise. You know, if you look at food prices across the globe, as you were just saying, there's still greedflation, but actually traded food prices in the global markets have come off massively. You know, they're way down from where they were. So that should feed into our inflation. And of course, gas prices, if you look at the futures, they've come off enormously as well. So eventually electricity prices in the off-gen price cap is going to come down. So you can see a world where a lot of that inflation dissipates because it's specific shocks. And yeah, and the Bank of England's done quite a lot already. So yeah, we'll probably get another one out of them, but hopefully they might go for a big, fat, pregnant pause as well.
Okay, but if we have the US, the UK, and Europe all on a sort of core services, core goods type of inflation of about 4%, let's say, by the end of the year, is the Bank of England and the ECB going to be happy on negative interest rates or zero real interest rates? I mean, negative, you know, effectively, without, you know, if you strip out the actual inflation, because will that actually solve the problem? That's the question.
Well, I think it will. I mean, oh, sorry, Edmund.
No, go on, Chris, go on. Yeah.
Well, I was going to say, you know, that we have this idea that it's all about real interest rates, and nominal interest rates have got to be above inflation. That's kind of the economic thinking of one school of thought. But really, I would say it's about controlling the money supply. Historically, if you control the money supply, you control the inflation. And they've controlled the money supply. Let's say that job is done. So it depends how you think about inflation. There's a ton of ways of thinking about it, right? And we could spend hours talking about it.
Okay, well, let's not do that. Okay, well, I've got the biggest issue now, Edmund, of the day is obviously what is happening in the banking sector. I mean, you know, we had the head of JP Morgan saying the other day that all the coast was clear, and then we went in First Republic, and then last night PacWest shares absolutely halved in value. We're down 50%, etc. What is actually happening? Is it? Yeah. What's your best view?
Well, I think what we're doing is seeing that we've seen the weakest banks already go to the wall. You know, First Republic, Signature, Silicon Valley Bank, and Silvergate, and they were all actually pretty big when you think about it. The problem is now that the market's got a taste for blood and is going after the next candidate, basically. Yeah. I mean, because if you were to look at it on the actual metrics, such as deposits, such as capital ratios, and so on, and the mismatch of asset and liability duration, PacWest is nothing like as bad as those guys. I mean, in fact, the market's been quite rational and taken out and basically shot the worst candidates already. So, of course, as we go down the line, we get into the less bad candidates, but still the worst of what's left. And remember, there are 4,000 banks in the US, which is far too many. If you think about it per head of population, that is a density far, far greater in the US than in Canada, Australia, UK, or even continental Europe. So the question is, why so many banks? And that's a very good question. And I think the answer is you don't need so many banks. You do need the banking service to be provided to companies and to individuals, obviously, but you don't need so many banks to do it, as we've seen in all these other countries. We seem to manage perfectly fine in the UK, in Europe, Canada, and so on. Don't need so many. But there is that rationalization that needs to happen. And I think, you know, JP Morgan absorbing First Republic is obviously one step on the way. I think PacWest is going to have to do something because, as you say, now they're on that decline. And even though deposits actually since the 31st of March, according to PacWest, went up, instead of gone up in the last month, that doesn't seem to help. No. So I think they will have to find a solution, whether it be a buyer or a merger with somebody else, so they can reinforce the balance sheet and so they can calm the risk of deposit flight. But ultimately, Paul, the bottom line is deposit rates at banks in the US are too low. The alternative is money market funds whose yields are 4.5% towards 5%. You can even buy US government bonds short dated at 5% plus. That's the problem. You know, you could argue that a lot of households are making an irrational arbitrage and saying, why am I getting 0.5%? Or even if you make it 2%, still only 2%, I can get 4.5, 5 down the road. And that's what's happening. So actually, ultimately, if push comes to shove, I think actually this is not a crisis, but could still become one. And I do think the authorities will have to go further. And the nuclear button would be if the Fed had to cut rates. Because ultimately, if they were to cut rates, let's say, from 5% to, let's say, 4 or 3, the money market yield would come down, which means the alternative to bank deposits is no longer going to be as attractive as it is today. Because that's the problem.
Which would help the banks, wouldn't it, I guess?
Which would help. Yeah, that should help. Which would help the banks. I mean, of course, the other thing banks can do to help themselves, which will hurt them in the short term, but may solidify them in the medium term, is simply to raise the deposit rate to 3% or even more to make their deposit accounts more competitive, to effectively minimize the cash arbitrage between what they offer in their deposits and what people can get elsewhere. Now, if you make it smaller, then people maybe don't bother. They keep the deposits with you. Okay, you lose profitability because what you're doing is you're obviously not making as much on the gap between the loans and the deposits, which is what the net interest income, that's what the bank should be making. They'll make less, but at least they'll stay afloat.
Yeah, okay.
I think there's a couple of issues. If I could jump in, Paul,
please do.
There's a couple of challenges. The problem with raising deposit rates, of course, is you undermine your profitability in a big way. And I think there's a lot of business models in the last 12 years or so of financial repression, which are basically built on cheap money and free deposits, which is funding. If you're a bank, that's effectively your funding for your loan book. The other thing I think people aren't really fully thinking through on this banking system in the US and perhaps in other parts of the world, but particularly the US, is that it's not just deposit flight anymore. It's not just the fact that treasuries have been marked down 20%. It's the fact that their loan books are going to come under pressure because all the assets that they've lent against have to be repriced down. We've repriced up interest rates, which mean you have to reprice downwards asset prices, commercial real estate in particular. Everyone's talking about where there are very high vacancy rates in offices, but also all the zombies that they've been lending to for 15 years. The zombies, if you look at UK corporate insolvencies, they're almost as high as they were at the peak in 2008. The zombies are dying. I don't know how you kill zombies in movies, but in an economy, you kill them with high interest rates. And it's working. And so I think the banking system's it's broader than just this deposit flight story and this securities story. It's a much broader, it actually touches almost all areas of their balance sheet. So I'm not surprised that the market's got other banks in their sights. And I think it's pretty clear there's more to come. Whether you call it a crisis or not, who knows? But the fact of the matter is if a ton of banks go bust, credit conditions tighten up and the economy comes under more pressure. And that's, I think, what we're going to see. I think one of the most important data points in the next few weeks, in fact, next week, is the senior loan officers survey out of the States, where they're going to give us an update on credit conditions in the US. That incorporates what happened in March and April. So I think all eyes on that.
Yeah. And then just in terms of sort of picking through the carcass there, Edmund, with banks, is there anything out there? I mean, if you look at sort of like one company, Barclays came out with some pretty good first quarter results, but it's still trading at about 50% of net tangible book. And likewise, I mean, JP Morgan's the other end of it. He came out with blockbuster numbers and is trading about, 1.5, 2 times book, etc. But there does seem to be a huge difference or dispersion in terms of valuation multiples. I mean, is there any place you can safely tread?
Well, I do think that European, and that includes UK banks, are actually interesting right now. US banks, maybe not, because as you say, the good ones are very expensive and the bad ones you don't want to be in anyway. For the reasons that Chris just mentioned, you've got pressure on loan books and you've got questions about deposit flight. But in Europe, we don't see deposit flight, really. Capital ratios are very high. And on top of that, we are not seeing, the difference being that banking regulators in Europe and the US were pretty tough in the aftermath of the GFC, the global financial crisis, in tightening up regulations for banks across the board in Europe and the UK. In the US, it seems that there were 2 tiers of regulation. There was the big guys, the G-SIB so-called, like JP Morgan Chase and Bank of America, who had very tight regulations imposed. And then you had the other guys in all the regional banks who, for one reason or other, presumably political and a bit of pork barreling, as we say, managed to escape with lighter regulation. And this has now come home to bite, obviously, the US administration. It was maybe a mistake to have allowed, and I think the Fed has almost sort of admitted that, say it was a mistake to allow laxer regulation on the smaller banks. We should have, they should have done what was done in Europe and the UK, just all banks get the same tough regulations, and that's it. But for that
actually,
reason,
sorry, I don't mean to interrupt. Sorry, I was going to say you made the point very well that actually, as you said earlier, banking assets are heavily concentrated in Europe. So 4 banks are 70–80% of our banking system, and because they're big banks, like you said, they would be differently regulated. And but it was Trump. I think, that loosened the regulations on the mid-sized banks.
Yes, that's right. The end of the Dodd-Frank Act. Yes, classic
deregulation. Yeah.
So Edmund, in terms of if there's some interesting opportunities in banks in say the UK. I know you mentioned sort of Natwest and Lloyds, which is trading at the slight discounts.
I would say absolutely the retail banks because they're boring, and as I said, Paul, very high capital ratios. De-risk business models because they've been simplified because they were forced to get out of a lot of the riskier stuff like investment banking. And right now you wouldn't want to be in investment banking anyway, because where is the merger and acquisition activity? It's pretty light on the ground. Where are the IPOs? Well, there's zero, frankly. So, this is maybe one reason why Numis did agree to be taken over by Deutsche Bank, because it's a tough old world out there for corporate brokers in the IPO market, and it's a tough old world for investment banking in terms of mergers and acquisition deals. There just aren't many. So,
what's your favorite pick, Edmund? Can I ask Edmund a question? I'm just curious what his favorite UK bank pick is. I find the whole sector intriguing.
Well, I would probably go, as Paul said, I would probably go with it. I actually looked at the Lloyds results recently. They were pretty good. And it's a solidly boring bank. It still offers a very well-backed and high dividend yield, very high capital ratios. And as far as I'm aware, they have not gone back into the lunacy of offering anything like 100% mortgages again. I know there's been some hint of that in the UK from, I forget which lender, but for the most part, the high street banks are nowhere near that sort of lunacy.
Right. Okay, good. Now, just turning sort of like gears into the sort of tech sector. I mean, they came out with some blowout numbers, the Meta we've talked briefly about, but also Nvidia and Microsoft. So, Chris, is that as good as you get? Are these things priced to perfection? Is it time to pull the ripcord, or would you hold them up, given we go into recessionary times?
It'd be really weird stocks to hold going into a recession, wouldn't it? I mean, I know there's some fantastic companies, but it's kind of sort of Charlie Munger's point, isn't it? Price is what you pay and value is what you get. I think the PE ratio on Nvidia is more than doubled this year on forward earnings.
It's 80 times now.
80 times. Okay. It's not a small PE ratio. It's quite something. I mean, it sort of reminds you a bit of late 1999 in terms, I remember Qualcomm at the time went up multiple times in price and PE ratio. And also, I don't think it's a sign of a healthy market. I think the really interesting thing, if you look at technology as a global sector, relative to the market, it's more expensive than it was in late 2021 when it last peaked. And it's only been more expensive in the TMT bubble. So we're incredibly expensive in aggregate as a sector. And a lot of that, of course, is Microsoft, Nvidia, Tesla, all the PE ratios on these stocks. And I have to say, I think when you think about markets, every 5 or 6 years, leadership changes. And I'm pretty sure the leadership is not going to be tech over the next 3 to 5 years. So I hope you enjoyed the ride, but it's not going to go on forever. I'll be pretty cautious on that stuff, frankly.
Okay. Well, we're really lucky today because one of the sort of the key sort of like, boosters for all things tech this last fall has been artificial intelligence. And the little birdie tells me that Edmund has got a PhD in all things AI. So do you want to give us a quick view on how you see that sector? Because it does seem there's a lot of reality. It isn't just hype.
Oh, no. Absolutely, there's reality. But there's two things here, Paul. I think artificial intelligence as a group of technologies and as a theme has come of age. Then there's a second question, which is how do you invest in it? And that's the tricky part, because I think the answer is actually not to buy Meta or Google or Microsoft, because you don't know who's going to win in the long term out of AI. And it may well not be, the winners may not be the obvious ones, actually. The long-term winners may not be the Microsofts who integrate ChatGPT into Microsoft Office, or Google who have Google Bard or whatever. But it may be the companies that best harness the power of artificial learning and artificial intelligence and machine learning in their own businesses, change their own businesses fundamentally to improve productivity and to boost growth, those companies may be the biggest beneficiaries. And honestly, at the moment, we're still not sure who they are, because it takes a surprisingly long time for any new technology to be adopted broadly in industry and in commerce. And I think we're still in the early stages of that adoption cycle. People are still thinking, okay, this is like a hammer. It's a really useful hammer. I'm still not quite sure what I can do with this hammer as it applies to my own business model. Because that's a big challenge. We will get there, but I think the winners from that will emerge slowly. And they may be, in heavy industry, they may be in industrial automation, they may be in the consumer sector, for instance. Maybe there's companies who can best harness chatbots to better serve their customers, to improve customer service and therefore customer retention, like Amazon does today. It could be other customer-centric businesses that can harness the technology the best, that may be the long-term winners out of this.
Just in terms of that hammer, though, in terms which ones are going to get absolutely sort of cudgeled around the sort of the losers in the sector? Because we had Chegg the other day, basically saying that its shares dropped by 50% on the back of an AI risk for its online education, and Pearson came out in sympathy and also dropped by 15%. Is there any way of identifying who's going to be seriously disrupted very quickly?
No, it's going to take time. It's going to be tricky, but I would say the best argument here would actually be white-collar services. White-collar services, because unlike, say, industrial automation, which basically replaced blue-collar manufacturing jobs, car making, you have industrial robots instead of people, putting the pieces together. This is a bit different, because actually what will this attack? This will attack probably accountancy jobs. This will attack low-level lawyers' jobs, legal services. This will attack back office functions in finance, for instance. So these are white-collar jobs which involve a lot of routine. And I think those jobs will be more easily replaced by AI. So I think that's where the pressure comes. So the companies that provide maybe the legal service, but that doesn't mean that the companies that provide legal services lose, because people still need legal services. It just may be that the employees lose. The companies may win by implementing a 24/7 chatbot that doesn't complain, doesn't go on strike, doesn't ask for a wage rise, right? Is much more productive and effective. But I think ultimately the winners and losers will be determined by which companies grasp the opportunity, and also which employees grasp the opportunity in terms of enhancing the way they do their job with this new tool. And those companies that do not. So it's a bit like when Netflix arrives, they grasp the possibility of online streaming, and a company like Blockbuster just clearly didn't. Because remember, Netflix, like Amazon once upon a time, sent DVDs out by post. That's the genesis of their business, but they saw the light, they went massively to online streaming, they invested massively, and they seized the opportunity, whereas Blockbuster, who could have done the same thing, obviously did not and ended up going bust.
Well, I think
that's what we're going to see. Something like that.
Yeah, sorry.
It was Love Film, wasn't it? Isn't that
it was
Netflix?
Love Film, exactly. That's it. Bought by Amazon.
Yeah.
Well, I think we're going to have the AI story going as a theme for the next few months, or years perhaps, because we'll certainly see some differences and disparities in performance. Now, Chris, in terms of the all things consumer, that's really been one of the engines behind the economy in the first 4 months. How are you seeing that sort of momentum going into the second quarter and into the second half? Because everybody's going overseas holidays, the casinos are absolutely rammed, and people are going out to restaurants. In fact, the restaurants around here are more busy in the last 3 months than they've been into the run up to Christmas.
Well, the revenge spending's been alive and well. No, I think the consumers are going to run out of steam. I mean, they're going to run out of savings. I mean, if you look at all the sort of projections of whether you're in the UK, the US, or other parts of the West, the numbers are ticking down. And actually, what you're starting to see is a bit of a stress at the margins. Obviously, it starts with a very low income and then spreads up the income chain. It never really gets to the high income guys, but yeah, you're seeing average credit card balances going up because they're not being paid off as fast. You're seeing people trading down, as Edmund said earlier. That's a sure sign of income stress, and all sorts of bits and pieces and signs like this, which I think are really pretty interesting and telling you that the pressure's coming to bear. And you can see it. I mean, inflation has eroded a lot of those cash savings, and it continues to erode it still, because we've we still got inflation. So I think we'll find by the second half of this year, things start to look a little bit more ropey. The projections in the US are that all that extra cash is gone by the middle of this year. So, consumers will be running on empty. And it also looks like the job market's about to start cracking in the States. So again, that hits confidence and precautionary. People want to save a bit more because they're a bit worried about life. So yeah, I'd say it's been a great run, but it's running out of steam.
Right. The one pushback on that is such that if people in the work from home sort of like, sort of era, then it means that people aren't spending as much on travel. They're not on the coffees down at Starbucks. They're not in lunches, etc. So they're saving naturally. Their disposable income is higher. And likewise, now you are getting, for savers and pensioners, you are actually getting a return on your cash in the bank.
Yeah, but be careful with that, Paul. Be careful with that, Paul, because I think consumers have adapted. So anyone who works at home has adapted, unfortunately, their lifestyle. So yes, they would have saved originally, but now they're just going slightly more expensive holidays in the summer. And I think to Chris's point about there are certain areas of consumption which will hold up this summer, like travel. I think that will hold up this summer. But I agree with Chris. It's quite clear that the boom times have ended. The only question I have is whether the salary increases may come through just at the time when inflation is falling. They may cross over, and actually people's real incomes may go from being sort of like negative year-on-year growth to positive, because inflation's coming down. The pressure of inflation comes down just as they're getting bigger. The salary increases are working their way through. But even then, that's not going to boost consumption. It just might hold up consumption or slow. So it may slow down less quickly than we might otherwise expect.
Good. Okay, we'll just turn into different sectors. Obviously, we had the Chinese reopening, and that sort of boosted some of the luxury suppliers, LVMH, as we mentioned last time. But one area that really is trading at sort of rock bottom levels is the whole sort of like, industrial metals, the likes of Rio Tinto, BHP, Billiton. What do you see in that sector, Edmund? Is that sort of like an error? Is it a value trap or a value play? It's difficult to know.
I think it's a value play for those who are patient, because, to Chris's point, if you're expecting US recession later this year, and this is exactly what's reflected in the oil price and the metals prices, slow down in global demand. That makes sense to me in the short term. But if we look out to next year and beyond, I think that picks up again, because again, you just come back to basic points like the energy transition. The amount of copper, just copper, you're going to need if you're really going to be serious about energy transition and driving electric cars and the rest of it, is enormous. And the problem is we are not opening new mines. So where does this new supply come from? In fact, Paul, what is quite interesting, if you look at companies like the Glencores or the Rios or even Codelco in Chile, which is the world's biggest copper company, is that volume production of minerals like copper and other industrial metals is going down, right? We're not even keeping it flat. It's actually going down. And so the problem is we need to grow it at a time when it's actually shrinking. And by the way, global stockpiles are also very low. So I think in the short term, the recession concerns are dominating commodity prices, but I don't think that's going to last. I think for those who are patient, you can buy the miners on very discounted levels. You will need to be patient, but in a year or two, I think things will look a lot better. And in between times, you pick up a very healthy and well-backed dividend yield.
Good. And what about the sort of the lithium sort of sectors? Because I mean, that's obviously the number one sort of like metal which goes into EV batteries, etc. That's come off. I mean, the biggest sort of like poster child of the sector is Albemarle out in the States, and I think its shares have halved. They're trading at about less than 7 times PE. Admittedly, can you trust the earnings? I get it, but what do you think about that sort of area in terms of? Well,
I like lithium. The problem is you've had a very specific story there, obviously, about Chile and the story doing around that it's nationalized, or it's going to nationalize the lithium industry in Chile, which of course is one of the biggest suppliers of lithium in the world. Albemarle, like SQM, Sociedad Química de Chile, have big operations in Chile, so they're exposed. However, it's not really true that they're nationalizing the industry. This is, when you dig into the detail, it's not as simple as that, first of all. But it clearly has hurt sentiment dramatically. And as you said, lithium carbonate prices have also slumped of late by a lot. But then again, they were up massively before that. So in a sense, you had a bubble, you've deflated the bubble, but the long-term growth rate in lithium is still there, both in demand in volume demand, but also in pricing. It's just that we had a bubble in the pricing. It's deflated, and I think now we got back to the underlying uptrend. And the problem is we're going to need, again, tons and tons. If you really believe in electric vehicles and the demand for large-scale lithium-ion batteries, we're going to need so much more lithium than we have now. And I think, if you're going to worry about Chile, then you're going to look for a lithium elsewhere. The rest of South America, like Argentina, obviously, Australia being the other huge producer of lithium. I think these will become more and more in demand as time goes on.
Good. Okay. Well, just switching to different resources, oil and gas, Chris. Sort of square the circle, I guess, between the underlying crude price, which is decreasing, and the sort of oil stocks and the gas stocks, etc.
Well, I mean, we've got a supply surplus this year in the world. Amazingly, you wouldn't have believed it with all the chatter that we had after the Ukraine war last year, that where the world was going to be massively short of oil and the oil price was going to $200. This is what I love about commodities. They adapt. The price drives change. Politicians wake up. They change energy sources. They find other energy. And as is always the case, going back as far as I can remember, whenever someone produces oil, it always gets out somewhere. It's a fungible commodity. It's very easy to disguise. There's this wonderful stat. I think it's Malaysian exports of oil. I think they're exporting about 4 or 5 times the amount of oil they produce. In other words, it's all turning up, being into the docks and out the docks the other side. The oil gets out. And so the inventories this year are going up. The supply is fine. There's plenty of oil around. And as we go into a recession, of course, demand comes off quite meaningfully. So, I'm with Edmund. I think we're in a commodity super cycle. And I think it began a year or two ago. This is the first one we've had since, we had one from 2000, 2012. Then commodities were in a bear market until a year or two ago. And now they're in a super cycle. And the thing to do in super cycles is you've got to rotate commodities every year. So this year is the year for precious metals. And when you see industrial cyclical stuff beaten up in the recession, as we're seeing with oil at the moment, as I said, it's off 11% in 3 days. At some point you want to pick those up this year. It's going to be a fantastic opportunity to buy this stuff over on a sort of 3 to 5 year view and buy the stocks and companies that go with it. Because there's been a clear lack of investment in so many commodities. And as Edmund was saying, there's a green reason to buy these things. There's lots of reasons to buy them, but certainly the greenification of the world and decarbonization, climate, all that stuff is very commodity intensive if they're going to make it happen. So yeah, oil's, yeah, it's been fun to trade oil. It's a lot of volatility.
How would you play?
You've got to be quick.
What would be preference in terms of how to play that? Would it be the integrated oils, the likes of Shell, BP, who came out with terrific results actually over the last few days, and Exxon, or would it be in sort of like the more shale guys where there's a low, sort of like cost of extraction, the pioneers?
I would say stick with the integrated names because, as you said, specifically those who have the best capital and cash flow discipline. You mentioned Shell, excellent results this morning again, and yet the shares didn't move because, as Chris mentioned, the price is under pressure because of the recession fears. But remember that even though refining margins are coming down, they still remain higher than normal. So look, they're cyclical. They're not going to stay at a peak forever. They come down, but they're still higher than normal. So actually, on the downstream operations, which includes refining, integrated oil names like BP and Shell are making more money on average than they normally would. And even if that comes down a bit, that'll probably still remain true because, again, exactly as you said about oil production, oil refining, there's been no increase in capacity anywhere. I mean, there will be a bit in Saudi Arabia this year, but it's in Europe, zero. No one's opening a refinery, or nobody, because no one wants to run a new refinery. Who would invest with all of the ESG considerations and all the talk about energy transition? Who on earth would want to invest in a new refinery with a payback, an investment payback that will be 20, 30 years? Nobody. Which means to me, refining is a good place to be in the meantime.
What about sort of the consolidation in the sector? Because there was obviously, mooted rumours that Exxon would be interested in buying somebody like, Pioneer. What's your top level view, Chris, in terms of M&A in that whole area?
Well, it seems like a no-brainer, doesn't it? They've got a lot of cash to put to work, and companies, a lot of them are quite cheap, and the underlying commodity prices are quite cheap in many cases. So it's kind of ripe for consolidation, I would have thought. There may be some companies don't want to become more focused on specific commodities that the market doesn't like because of ESG factors. But, you know, if you look at the oil and gas sector in aggregate, it's trading at about a 50% discount to the market, which is, you know, miles cheaper than it's ever been, except in the last year or two. So even though they had a very good run last year, they're still incredibly cheap stocks, which, yeah, that combination's got to make you think there's some M&A coming, or some more M&A coming.
Yeah. So am I correct in thinking then, guys, probably the two favourite sectors are resources and oil and gas for super cycle? Is that a correct assessment?
For a long-term investor who can weather the shorter-term volatility, close their eyes and pick up the dividend yield and not sweat it. Yes.
Okay, good. Now turning to another area where we have a lot of M&A going on, Edmund, and this I know it's not related to your PhD, but given you sort of like you're probably an expert at this, healthcare. We've had sort of like you know, you've had Pfizer bidding for Gen, you've had AbbVie also trying to replenish its pipeline and stuff like that. How do you see sort of the healthcare sector? Because again, big pharma seems to be trading at pretty cheap valuations, other than one or two like Lilly and Astra. I think are quite expensive.
Yeah, I think in general, I always like, for the long-term defensive investor, I always like healthcare because it has been one of the long-term outperformers. If you look historically, it is a high-quality sector, so you tend to have a little bit less volatility, particularly with the big names. With the biotechs, different story. You have huge volatility because obviously this can depend on whether a promising drug gets, passes the trials or doesn't pass the trials. You get a lot of event-specific volatility in the biotechs, but in the big companies, a lot less so. And actually, again, you have a lot of very positive drivers in the sense that aging populations mean demand for healthcare, if anything, goes up. And actually, if you think about healthcare cost, most of the healthcare cost is not in drugs. It's in things like, hospitals, clinics, old age people's home, nursing homes, and that's going to become more and more the case. So any drugs that can effectively reduce the need to stay in hospital or go to a clinic or live in an old people's home and a nursing home, the better, because it's actually, even if the drug itself is relatively expensive, it's cheap relative to the alternative. To the problem it's solving. And I think particularly anything around drugs that help with dementia and slow that sort of cognitive impairment. And you mentioned Lilly. Lilly's literally just come out with a drug that looks extremely promising. And it's really the first drug that is showing really promising results in this sort of Alzheimer's stroke dementia area. And I think that's a huge area of growth because it's so poorly treated at the moment, as we know. There are no effective treatments on the market today. So the first couple that come out that really are effective, they're almost certain to be blockbusters. And so for the sector as a whole, I like it because I think the long-term demographic drivers are still there. I think there is a lot of promising drug pipelines as well. And this is partly actually related to artificial intelligence. We are finding so many more promising drug candidates thanks to the clever use of things like artificial intelligence. We're also finding things like better diagnostic tools. So we're catching things like cancers and other health issues earlier, again, because of advanced diagnostics, thanks to machine learning and artificial intelligence. So this technology does also feed into these medical advances and helps the sector.
And have you got any preferences or areas that might be, particular stocks that that people might want to have a look at?
Yeah, well, I quite like looking at some of the UK names. Well, the Glaxo and Haleons, for instance, particularly the Glaxo, because of course Glaxo just spun off Haleon, so you had it split into two products. And maybe the company Glaxo is worth having a look at. Astra, as you mentioned, is very expensive. A lot of the pure pharma peer group are very expensive, but something like a Glaxo may be worth a look now. Finally, now that the consumer businesses have been spun off.
Good. Okay. Now just turning to the house builders, Chris. I mean, another area that has been beaten down, has recovered slightly from the problem with Brexit and all things that are like trust last September, etc. What's your sort of view on the house builders? Because they're trading at about sort of like net tangible book at the moment.
Yeah, I mean, there's this sort of you've got to have a view on house prices and a view on house builders. They're kind of, they're related, but they're distinct. And yeah, I think the house builders have discounted quite a lot. I think that's a fair point. And they tend to do well once you start getting rate cuts. So we're not quite there yet, but perhaps we're not as far away as people think. So I wouldn't be, they have a very, very early cycle in new bull markets. I'm not suggesting we're in a new bull market yet, but they're one of the things that would do pretty well first off. If I look at house prices, though, rather than the home builders. I mean, obviously the home builders helped by the fact there's a shortage of housing, all that kind of story. But if you look at the actual house prices, they seem to me still at completely the wrong level, given interest rates have shifted and house prices haven't shifted enough. So I'd be more cautious on house prices, but more encouraged by the home builders. I think there'll be a moment to buy them over the course of this year.
Because the US cousins out in the States, I mean, they're at all-time highs at the moment in terms of pricing. It's really strange disconnect.
Well, it is, but sorry, Edmund, I was going to say it's completely different from what we saw in 06, 07. You know, there was a boom in lending, there was a boom in new buyers, there was all this kind of stuff leading into 06, 07. We haven't had that this time. In the US, there's almost no homes that aren't sold. The inventory of unsold homes is extremely low. But you haven't had all this crazy lending into the sector, and the US guys are really a play on 30-year bond yields. So they've peaked and come off. So yeah, I think that's kind of what's going on there.
Yeah, and I think as well, if you look at US home builders versus UK, US home builders have actually been incentivizing new home buyers, for instance, with discounted mortgage rates. So it's almost like an all-in-one package. You buy a new home from a home builder as opposed to a used home somewhere else, and you get a cheaper mortgage via the home builder and maybe some other discounts as well. So it's actually cheaper to buy a new home than the equivalent used home because of the better mortgage rate you get as a package.
Okay, good. Okay, well, we've got some big economic data coming out over the next month, looking into the crystal ball. But one thing, obviously, is the US debt ceiling. So I don't know what your view is on that one to start with, Edmund. Is it going to get solved, or are we going to have a real sort of like go to the wire again over the next 4 weeks?
It's always frustrating. You do wonder, why is there an absolute debt ceiling? I think the only other country that has it, something like Denmark, and even with Denmark, the debt ceiling is so far away from the absolute amount of debt that Denmark has, it's never an issue.
Yeah.
So why? It's just an anachronism that the Americans have. But I think ultimately the answer for me is that neither the Republicans nor the Democrats want to be blamed for shutting down a government. And this could happen theoretically by early June, the way things are going. Now, it's interesting to note that by the end of June, the Treasury General account will apparently be able to receive a one-off amount of $145 billion. So if they can make it to the end of June, that money can hit the Treasury General account and ease the pressure so the government can continue spending. The question is, how do you get there if you're running out of money by early June? So you've got to bridge that sort of 3-week gap if there's no agreement. And the answer may well be that the government has to prioritize spending. They'll just say, look, we don't spend on certain things. We only spend on what we have to, maybe pensions and benefits, and we sort of cut the spending, or at least delay the spending until after the end of June on a whole bunch of other stuff, which maybe we normally would be spending on now. And they might just have to prioritize just to make the best of the dwindling cash flow they've got.
Just in terms of the debt ceiling, Chris, with regards to sort of like M2 money supply and liquidity, because I have heard this sort of thing at the moment, the Federal Reserve isn't issuing, or the Treasury is not issuing bonds, etc., up to, obviously, because it can't, because up to the potential cliff edge with the debt ceiling. But afterwards, there's an absolute sort of like, huge number, over $1 trillion in the first 3 months, which are going to be. What's your view in terms of liquidity and M2 money supply in that third quarter if we do get a resolution to the debt ceiling?
Yeah, I wouldn't think of it in terms of M2 money supply, which is more sort of economic money supply, but I would think of it in terms of market liquidity. I think it's really important in that respect. And there's certainly, for me, liquidity is a massive driver of financial markets. And there's definitely a theory out there that the reason we've had such a strong bear market rally, if you like, from October through to where we are now, it's because there's been so much liquidity around. As Edward said, they've been running down the Treasury General Reserve account, which means they don't have to issue debt. And when you issue debt, you issue debt into the financial system, you suck liquidity out of markets, and there's less for the stock market. So part of all these kind of factors have been at work and really boosting liquidity. So when they start issuing debt, once they've resolved the debt ceiling impasse, which it looks like, I mean, it's hard to believe they won't, but let's say there's a tiny percentage chance they don't, but let's assume they do, then they're going to issue a lot of debt. They're going to suck a lot of liquidity out of financial markets. So I think it's going to be really interesting, a really challenging time for markets, a very different environment from the last 6 to 9 months. Not just TGA, you've also had the Chinese doing liquidity in the last few months as they've reopened their economy. So we could be in a very different liquidity situation in 2 months' time. And it could be much trickier stock markets. If you look at the relationship of the PE ratio of the S&P 500 over the last 12 years with QE and QT, it's quite tight. You know, whenever they create liquidity, the PE ratio expands. And normally, whenever they do QT, it contracts. It's just in the last few months that hasn't happened. And I think it's to do with this TGA stuff. So I critical times, I think, coming up for the stock market.
And so putting all that together, where would you expect the sort of S&P to be by sort of like the end of this year? I mean, we're trading at what, say, 4,200 or 4,100, etc.
What a great question. I think, you know, I think as Ronald Reagan said, give me a one-handed economist, I'll give you a view. I think it's very dangerous to do a point estimate at a certain time.
Right.
But let's put it this way. You know, the stock market is too expensive and earnings are too high. So both of those need to come under. I'm thinking of the US. It's most obvious in the US. The UK market is not expensive, neither is the European market. But the US market is very expensive. Earnings are too high. They both need to come down. And, you know, the timing on that is always tricky to know. But I would have thought over the next 6-9 months, that's the sort of thing that's going to play out.
And if that happens, Edmund, what will that do to the European and the UK markets in terms of if the US market does fall over the next sort of 6 months? Will you get, even though it's at a much lower valuation?
Well, this is interesting, Paul, because I could put it to you this way. If you look at the S&P over the last 2 years, do you know what the performance is?
I guess it's down.
Zero.
Oh, zero. Okay.
Literally from April 21, well, let's say April 21 to now, it's slightly down if you take May. If you were to take April 21 to now, you're literally flat on a price basis. So all you've earned are the dividends, which, as you know, in the case of S&P is not that much anyway. And over that period, all pretty much, well, the UK, Europe, and Japan have all done far better. So my betting would be, now I'm not saying that, you know, we always say that if the US if US sneezes, everyone else catches a cold, right? So the risk is always that if the US market goes down, everyone else goes down. But my betting would be that there will be some continued rotation out of the US into other stock markets. So they may not fare quite as badly because, as Chris said, I think the earnings downside is less in China, Japan, Europe, UK, number one. The earnings outlook and the earnings have been pretty strong up to now in those regions. So I don't see why that can't continue. And secondly, the valuations, Chris pointed out, is far lower in each of these regions compared to the US, which is the outlier. So it may well be more of a rotation story. That doesn't mean it's very difficult to see they can do fantastically well if the US is going down, but it doesn't mean that they go down in the same way as the US goes down at the same time.
Well, I mean, I'm guessing when we look into 2024, if we do have a sort of like a recession or slower conditions by this same, you know, the end of the year, if lower inflation, etc., and higher unemployment, well, Edwin, in terms of, you know, you sort of have your view for you know, earnings for next year, because that's going to be the key driver of how we outturn the 2023, I guess.
Well, you know, I'm actually not that negative about earnings going forwards because I still think my long-term belief is that inflation will remain durably somewhere above 2%. So let's say closer to 3 than 2 on average for the next few years. And, you know, when you think about nominal earnings are nominal, right? So they include in a price component. So that means the pricing outlook could be a little bit more favorable on average if inflation is closer to 3 than 2. Right, particularly in Europe, where we've had inflation below 2 since like forever. I mean, this is a novelty to see inflation above 2%. In the UK, maybe a little bit less so, but either way, that could be slightly better for nominal earnings. And I also do come back to my theory that the sort of commodity scarcity and the commodity super cycle that Chris was talking about, I still think that's in play, and I think that can come back to the fore. And so those stock markets with a higher percentage of these commodity intensive industries like mining, like oil, which of course is true in Europe and the UK in particular, I think they can do quite well. And that's why I'm still quite a big believer, for instance, in UK equities for that reason.
Okay, good. All right. Well, thanks very much, gents, and look forward to hearing your thoughts in a month's time. Well, hopefully when we've had that debt ceiling resolved. So thanks for your time.
Thank you.
Thank you.